The shares of GE, General Electric, falling today after missing Wall Street's expectations on sales. We're joined now by an analyst who's an expert on industrial companies. He's got a neutral rating on the shares of GE. Nick Heymann from Sterne Agee Leach. Nick, good to have you with us.
Good to be here, Pim.
All right, so give us the update. When we looked at GE's results today, Jeffrey Immelt saying, all right, coming in a little light on sales. They've got some cash to deploy. If they can get the NBC Universal deal done, maybe they'll buy even more companies, but in the meantime, maybe a dividend raise or maybe some share buybacks. That's about it.
Yeah, that's what's basically on the table. I think people today got really concerned about the decline, roughly $1.5 billion, $2 billion shy on revenues. Part of that, maybe a third, was due to the shrink in the size of the capital operations, and the other two-thirds really was focused on the energy infrastructure, and there, particularly wind, fell 32%.
Wind turbines, right?
Wind turbines. And GE is very, very strong in that market, but the market is moving from terrestrial to offshore, and they are now just ramping up and developing new offshore product, so they clearly are going to see slower wind sales near term. You have the expiration of the investment tax credit at the end of this year, so there's a bit of a hole on the terrestrial side, and this goes back to the whole government infrastructure from China, from the U.S., that really didn't pan out quite as well as many companies, including GE, were hoping.
All right, so what is GE's strategy here? Because it seems as though you can raise the dividend if you've got some excess cash. Yep. You can buy back stock if you've got the cash. That's to try to keep the shareholders, well, at least happy. But judging by today's performance of the stock, the shareholders aren't having any of it. Is a dresser industry, is that the kind of thing that GE needs to do?
I think right now what's going on is that they realize it's indisputable if you increase the dividend, the cash flows are probably in good shape. The rating agencies, the bankers, all had to approve this, and in turn, there's a lot of question marks about the quality, about the mix of the earnings, how much do you pay for financial, which has been the recent area of recovery for GE's earnings, and industrial clearly but a little probably lighter than hoped, and not only now but probably in 2011, maybe even 2012. So what you're trying to do is be able to get the opportunity to take and restore the dividend from the finance sub to the parent. And a critical component of that is really selling off this long tail loss side of your commercial real estate portfolio. They're working that down this quarter. We think that should be accomplished by next summer. If you do, you have the prospect then of taking upwards of 40%, the historical payout to the parent, of maybe $6 or $7 billion in 2012, and returning that to the parent. That's about 25 cents, okay, of incremental dividend. And that in turn could be allowing GE's dividend to move closer to 75 cents by late next year for 2012. If you got a 2.7, 2.8 yield in the stock, you could have a stock in the mid-20s.
Now, does Jeffrey Immelt get high marks for turning the company around right now? Because it seems as though it's going to be a much smaller GE no matter what, and it looks as though they're kind of groping for industries to get in that they can actually show the kind of growth that shareholders have been asking for.
Well, this is an extended process, and it's an extended process because the businesses were maybe underfed on an R&D basis for an extended period of time. We've got R&D up 21%.
Medical, for example, right?
Healthcare is doing quite well right now. It was obviously weak for a while. But what he's also doing is taking the capital up at the parent, which today stands at $13 billion. As you mentioned, will go higher into the 20s once they sell NBC Universal. And they're redeploying it in businesses they know at prices that customers or investors are happy with. The dresser clearly also shifts them a little bit more into emerging markets while being 1 cent accretive for next year. So those kind of, if you will, safe, smart, incremental moves are really what now operationally we're having to being content with for the GE's performance on the industrial side near term. Financials continues to improve, and certainly, ironically, is not having the lifting effect on the share price.
Well, you raise a good point, because it seems as though this was the buying time strategy and it was specific to GE, but they haven't been able to participate in the cyclical upturn that a lot of the industrial companies that you cover have really been able to take advantage of.
That's definitely true, and I think the market is, just coming around to realizing it isn't just EPS and revenues. In the next 12 to 18 months, yield is going to be the fulcrum that will lift this stock.
All right, I want to thank you very much. Nick Heymann coming to us from Sterne Agee Leach, always expert when it comes to GE and industrial companies. Always good to have you with us.
Thanks, Pim.
All right.